I wrote a book called The Perfect Investment. Perfect investment, I believed, was in multifamily. Then I went on several hundred podcasts and wrote many, many blogs after that where I said, time out, it's not the perfect investment.
Ladies and gentlemen, welcome to Real Estate Investor MBA. My name is Tejas Gosai, and I've had the honor of helping hundreds of investors achieve the American dream by creating generational wealth through real estate. I've spent the past few years interviewing the most knowledgeable experts I could find in the business to cut your learning time and conquer the hardest subjects in the game. Check out rei.mba, which my team and I have packed with over 75 interviews and free access to our real estate roadmap, webinars, and publications. If you're listening, I am rooting for you, and you're already on your way to financial freedom. Cheers and happy hunting. I only bring the best guests on the show. Today we have Paul Moore. Paul, thanks so much for making it.
Oh, it's great to be here. Thanks so much, Tejas.
Yeah, I only look for people that can share some really great information. Your resume precedes yourself. I looked at your stuff, but I would much rather you tell us and the listeners your history, how you got here, some paradigm shifts, or just fill us in.
Okay, well, fantastic. Let's see. I started with an engineering degree. That was my first mistake. Then I got an MBA. I went to Ford Motor Company for 5 years, had my own staffing firm for 5 years, sold it to a public company when I was almost 34.
Wow.
And I really didn't know what I wanted to do. So I moved the family to the Blue Ridge Mountains from Detroit. I thought, hey, I'm a full-time investor now. And the truth is, I was not. I was a full-time speculator now. And I didn't know the difference, and now I know that when you're investing your money, your principal is generally protected and you've got a chance to make a return. But when you're speculating, your principal is not at all safe and you've got a chance to make a return. So I had a paradigm shift when I started losing money that I had made from selling my company.
As most do, right?
Yeah, right. And then I got involved in real estate investing and started flipping houses, flipping lots at a resort lake. And about 10 years later, I jumped into commercial real estate where I've been for about 12 years. I'm the co-founder of Wellings Capital, and we're a private equity commercial real estate fund. We invest in all types of, hopefully, recession-resistant asset types.
That's a great intro. Thank you for that. Can you go back for a second? What year was that when you kind of switched things up to commercial? You said 12 years ago, but there was something before that.
Yeah, I did one commercial investment actually in 1999, and then I jumped into residential real estate from 2000 to 2010. And part of that included building 7 or 8 houses. And I learned something really important. You shouldn't build a house if you don't know how to put your own doorknob on your house. I'm just saying. I found that out, but I was also flipping waterfront lots in 2004 to 7, and then in 2008 that got really tough, so we pulled back on that. But yeah, that was the dates.
Immediately, you are a seasoned gentleman who has been through a few cycles. So you banged through 2008, and then had to amp it up a bit because when you get into fund and all these other things, there's investors and SEC regulations. So how did you build that up? Or did you have advisors or guides?
Yeah, we kind of fell into it. We actually heard about the oil. We actually speculated. I did it again in the oil boom in North Dakota in 2010. And we found out when we were visiting there was no place to stay. In fact, my business partner, who has a small jet, had to keep flying back to Colorado or back to a different state if he wanted to spend 2 days there for the project we were working on. So we built housing for the oil workers and, managers, executives, anybody who came to North Dakota. We built a couple multifamily projects ground up, and we leased them out as furnished extended stay hotels, also known as man camps. And we that's what they call them up there. So we also built a Hyatt hotel. And then I actually had a mentor for a year that trained me all things syndication. And that's how I got into official syndication.
Okay, so I rarely talk about this, but my history is in hotel development in southwestern Pennsylvania, eastern Ohio, and northern West Virginia because of the
Really?
Marcellus Shale.
Oh,
And
yeah. Yep.
and so
I know about that's where I went to college for my engineering degree.
where'd you go?
I went to Marietta College for petroleum engineering.
Yeah, that's amazing. I never get to talk about this, but your circumstance is very similar to mine. My
Yeah.
family's from Pittsburgh, and then
Uh-huh.
my father's a doctor. He's like, "Hey, there's this shale thing going on. You should look into it." And
Right.
we had one Best Western hotel at the time, and there was all these drillers, and I started talking to them, and I was blown away. They're like, "This is going to be the promised land for the next however long with horizontal I forgot
Yeah.
the terms where they had the streams go out." So
Yeah, right, right. Did you
yeah,
do the
we
Best Western in Caldwell, Ohio?
know, but I know who did.
Okay,
Um,
well, so we have that in common. I know right where that is on
yeah,
I-77, exit 25 in Ohio.
yeah, just over the border. So just that, look, this is amazing to talk about because you saw an opportunity and then you had to build units and rooms and solve a problem, and then you got fully occupied. And it's funny, I actually manage a fund now too, so I'm taking a lot of that knowledge and I've adapted it to what I'm doing. But great digression. Let's talk about you. So bring us up to speed. What have you been doing for the past year and a half since COVID and dealing through this madness?
Yeah, we're doing the same thing we were before. I wrote a book called The Perfect Investment, and I know it's a humble title, thank you. And the perfect investment, I believed, was in multifamily. But then I went on several hundred podcasts and wrote many, many blogs after that where I said, time out. It's not the perfect investment. My book did not account for the possibility that people would be overpaying for multifamily by 20 or 30%. They'd be over leveraging it. They'd be using floating rate debt. And this is all going to come crashing down. And so
Mhm.
we stepped away from multifamily being a syndicator and we stepped into expanding. We really felt like investors, including us, needed better diversification, best in class operators, diversification across asset types and geographies and strategies, and even in the capital stack. So we've done 6 funds. And with these funds, we actually are not the operator. We're not directly operating the properties or property managing. We're actually partnering with the very best people we can in 6 or 7 different asset types. So that's what we do.
Wow, that's amazing. Tell me about the first fund, and then I'm assuming, and let me make a jump here, your investor base was okay with having different asset classes, or were the funds all one asset class, or how did that work?
It's really funny. When we dipped our toe in the water to expand from multifamily to perhaps self-storage and mobile home parks and then later RV parks, etc., we were nervous about that. So we had in our database a box I checked. Are they okay with other asset classes? Yes or no? And then it was yes, 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 yes. And like one person, like from Michigan, ever said no. One. And so we just finally got rid of that box and said, we're definitely doing different asset classes.
Yeah, that's
So
brilliant. So then, did you have to build the fund to take advantage of that and pool the investors?
we did. Yeah. So we used a similar model to the way we had been syndicating before, but there are special rules when you're not the operator. It's probably a little too technical for
Sure.
most listeners to be bored with. So I won't get into that, but there are special rules. And I'll say that we are using a BDC structure. There I go getting technical. And we're actually publicly registered. And that allows us to have the maximum flexibility with our fund and serve our investors the best way we can.
It's amazing. Can I ask, before we get into the deep stuff, how many investors, how many assets? You want to share some big numbers for the listeners?
Yeah. I mean, we have almost 800 investors.
Whew.
And they're all accredited investors. Each fund has a different size and has a different pool of assets we've invested in. So our current fund, the Wellings Real Estate Income Fund, is for accredited investors only. as
Yep.
they all have been. It invests in a variety of asset types, including self-storage, mobile home parks, RV parks, tax-abated multifamily, single-family home portfolio, light industrial, and open-air shopping centers.
Whew, that's a mouthful. Let's go right to date. Everyone for this year has had their playbook change a little bit, or their
Yeah.
futures, and also I say this in every podcast. I hate the fear mongering. I hate the whole you got to worry about everything. I rely on folks like you that have been through many
Mhm.
cycles and can kind of see things better than I can, or some of the younger folks. So, what are your investors saying right now? Or people kind of asking you, hey, what's next? And is that
Yeah.
changing where you're going, or maybe markets?
Yeah. The most knowledgeable investors we seem to have are really excited that we're actually investing in pref equity. So, preferred equity. Some people think that means rescue capital. Some people think it means the preferred return as part of the waterfall. It's neither of those. So let's say that a syndicator was expecting 75% LTV from his loan. And let's say that he was expecting to raise 25%. Well, now his lender comes back and says, hey, we're only going to give you 50% on this. And he can only raise, let's say, 30% equity instead of the extra he needs. And so we come in the gap. It's also called gap financing. So it's behind the loan, but the pref equity is ahead of the common equity. And that means we get cash flow like a loan. We
Yeah.
don't get a lien. We typically get a guarantee from the sponsor, like a personal guarantee. And
Wow.
then in addition to the cash flow, which can be 8, 9, 10%, we also get upside when the property is sold. And that might be an additional 5 to 8% on top of the cash flow.
That's
So our
brilliant.
investors really like that.
Yeah, they definitely should. Talk to me about the different asset classes, and I'm not asking you to rank them, but
Yeah.
some folks, and I wish I had a guest on Spartan Investments,
Yeah.
or I mean, I think they were only self storage.
Mhm.
And then there's some other folks that are just minting money with these RV parks and adding value and things like that. It sounds like you're doing a bunch of this, but can you hone in specifically?
I just want to make a comment first. I meant to say this earlier that the 80/20 rule is fractal, which means that if you get the top 20% of the top 20% of, let's say, operators, they're going to theoretically get the top 80% of the top 80% of results. And that's been proven by Perry Marshall, who wrote a wonderful book called 80/20 Sales and Marketing. And so this is why I just realized there's no way we're going to be in the top 4% of multifamily or self storage or RV parks, and especially not 6 or 7 different asset types. The book, The One Thing, which everybody loves, most people love, it reminds us, that we can only do 1 or 2 things, really just one, really well. And so that's why we went into these different asset types. And I would really encourage investors to consider investing with someone like Tejas because they're not going to be able to have a great job, a great family life, and then juggle a bunch of real estate on the side. I think that you would probably agree.
Yes,
And
absolutely. Thanks for that.
so, yeah, so we bring the diversification piece in. So let me just talk about a few asset types. RV parks, they've grown 62% in the first 2 decades of this century. Wait,
Wow.
that didn't sound right. That's right. Yeah.
Yeah,
Am I
first
that
two
old?
decades.
Yeah. So from 2000 to 2020, they grew about 62%. And then COVID just put the whole thing on steroids. 5 times as many people started RV camping in 2020, even when a lot of people were locked at home in their basements, as any other year. And
Wow,
so,
did not know that.
yeah, it's crazy. And so there's about 10 million RVs out there, but there's about 8 or 9 additional people who say they want to buy one. What's really juiced this is not only COVID, but the secondary impact, which is the fact that for the first time in world history, a huge percentage of people can work remotely. And so
Mm.
that's juiced RV park demand, but so has the Airbnb model, which is the sharing model that's come to the RV world. You can go on rvshare.com or
I did that.
outdoorsy.com. Did you?
I
How'd it go?
I never thought this would actually happen this way, but my wife said she won't go camping, right? So I'm like, our kids are 8 and 10. and I just rented an RV. It took me 10 minutes. It was a
Mm,
beautiful experience though. It was a little
wow.
bit tough to drive, but I love camping, love RV parks. I actually love just hearing about the investment part of it. But you're making me realize something. People can't buy an RV then, right? They're sold out kind of.
Yeah, and even if they're not sold out, the interest rates are so high right now that it used to be said, just 3 years ago, people were saying it's just like an extra car payment. Well, that may not be as easy to stomach right now, but they can lease them. And so these RVs that were sitting idle 49 and a half weeks a year are now on the road, some of them 10, 20, 30, even 40 weeks a year. And
Wow.
so that's putting tremendous pressure on RV parks. So I think this is gonna be a great niche, to continue to look at.
Let me ask you about that specifically. So, how do you add value to the RV parks? I'm sure there's a lot of demand, but what do you do to juice it a little more?
Yeah, there's 4 types of RV parks, and only one of them that I'm considering would be something where I would, that I would really know about, and that would be the destination RV parks. And so some ways to add value to those would be like, okay, so our operator has bought several RV parks, let's say for 2, 3, $4 million, and then their total CapEx budget might be 20 million. So they're buying all the land around them, or a lot of the land around them. They're putting in a fishing lake, a swimming lake. They're putting in glamping units. They're putting
Wow.
in a $2 or $3 million water park. They might add boat docks if it's on a lake, a cheap kind of a makeshift drive-in theater,
Yeah.
food service, putt-putt golf, doggy pens outside, cabins that they erect. All types of things. I just named about half of them. Golf carts that can be rented for more than the tent lots, 75 bucks a day for a nice looking, but not real expensive golf cart. Whibbits is another thing. You know about Whibbits?
No.
Whibbits is a floating obstacle course. It's sort of like this hard foam, and you can put it out on a swimming lake, and kids or adults can rent it. They can go play on there for like $17 an hour, which just seems like a low price, but the total in the high season can be up to $1,000 an hour being thrown off by this value add. So it's a real
That's
fun to
incredible.
do a lot of that. Yeah.
Yeah, I can see why people that invest in your fund, that it's good to hear about those things too. Just, hey, how are we raising the value? And I'm sure you
Right.
report that back to everybody. I mean, honestly, I would like to visit the place with the water park. I've never seen that. Very cool to share that. Can we switch to, like, people are always loving the buzzword self storage? Can you talk about that and why that became an asset class for
Yeah.
you?
Yeah, I wrote a book called Storing Up Profits: Take Advantage of America's Obsession with Stuff by Investing in Self-Storage. And that was published by
Brilliant.
Bigger Pockets Publishing 2 years ago this month. Anyway, that what we like thank you. What we like about self-storage includes the fact that think about this. If I was renting an apartment from you and you raise my rent 10%, okay, yeah, I get it in this inflationary environment, but in a normal year, if you raise my rent 10%, I'm going, okay, $1,000 a month just went to 1,100. If I sign this lease, I'm signing up for 1,200 extra bucks. I might move.
Hmm.
But if I'm renting a self-storage unit from you for $100 a month and you raise it by 10%, that's 10 bucks a month. I might be irritated, but I'm probably not going to get a U-Haul, get my friends together and waste a weekend of my life to move my junk, I'm sorry, my treasures down the street just, just to save 10 bucks when that guy
Yeah.
can raise the rent 10 bucks next month as well. These are month to month leases. And people
Mhm.
stay a very long time, even if they plan to stay a short time. America, again, the growth in self storage, it's been fairly consistent in good times and bad. These are pretty recession resistant. There's no guarantee that they'll be recession proof, but at any rate, the demand for self storage has been astounding. You can see that if you look around when you drive anywhere and see all the self storage units next door to each other that all seem to eventually get filled up. We like investing in value add self storage, which could be a conversion, let's say, of an old warehouse or an old Kmart building or an old Toys R Us building. And those can be very profitable if done right.
What markets are you in right now, just in general?
So Warren Buffett talks about, finding a durable product, a fantastic operator, and then let them make the detailed decisions. And that's what we do as well. We do not pick markets. We pick the best operators we can find. We're very, very picky. Once we find an operator we want to partner with, we let them pick the market. So it could be Wisconsin, it could be Ohio, Pennsylvania, West Virginia. They decide and we go along for the ride, again, after we put them through a very strong due diligence process.
Sure. Can you just share where you guys are?
So we're based in Lynchburg, Virginia, but as far as where we are geographically, pulling up a map here, we are in over 30 states now, and we have
Woo.
assets all through the Sun Belt. We have a lot of focus, a lot of concentration in multifamily in Texas. We have assets in New York, Pennsylvania, Virginia, Tennessee, South Carolina, Florida, Georgia, Colorado, Utah, Arizona, Nevada, California, Washington, Oregon, Michigan, and a few more states.
Wild that you keep track of all of this. How do you keep track of all of this?
We've got fund managers to do that. We've got a great guy on our team named Michael, and he works with Ben, my business partner. So this is something you might find interesting. I feel like I underperformed pretty significantly as an entrepreneur for years. And every time I tried to do stuff on my own, I didn't do that well. And then I came across a book called Traction by Gino Wickman. And Gino is actually an old friend of mine, but I didn't know he got famous till I saw him on a bookshelf one day.
That's amazing.
We actually ran his payroll for him in Michigan when we had the staffing firm in Detroit, Michigan. But anyway, the book Traction explains that you've got a visionary and an integrator, and you need both to have a great business. And I'm a visionary. I'm definitely not involved in all the details all the time. And so it wasn't until I got a fantastic integrator who's this young man named Ben, who's a prodigy. I actually unhired, how do you say that? I bought out 2 business partners and actually replaced them both with Ben, and he's doing 10 times more than maybe 50 times more than they were together. Now, to be fair to them, they both had other great businesses and they still do. But Ben is a prodigy, and he has pulled together a lot of my wild thoughts and visions, and he's willing to say no regularly to me as I come up with new ideas. And that's one of the things that's been such a blessing to work with him.
That's awesome. I love the growth, the scalability, and I don't meet that many people that have like multiple funds like this and multiple asset classes. So I got to drill you on what are we going to do over the next few months? Can you tell me about, what you think on interest rates? We have all this
Mhm.
geopolitical stuff, and there was more last night, and everyone's kind of funny. Can you
Yeah.
share, just what you think for the next year or onwards, or when we're going to feel a little better about all these things?
Yeah. The geopolitical is a complete wild card, just like COVID was. So I really can't speak to that so much. I can tell you, I talked to the former head of the Mortgage Bankers Association who lives near me. I spoke with him on Tuesday and I said, what's the future of interest rates? And he said, well, they're done making interest rate hikes for now, but he said the volatility is going to continue and interest rates are not going to go down too soon. He doesn't think, unless there's some huge geopolitical, thing that just throws a wrench in it. But
Right.
there's 200. Is it 200 billion? I think in multifamily. It's either multifamily or commercial real estate loans as a whole coming due in the next short period, like,
I just
I don't
saw
know if
that
it's 6
article.
months, 12 months. Yeah.
Yeah, it just came out. What does that mean, though? What does that mean for someone like you or somebody out on the street?
I don't mean to sound arrogant, but we have been really, again, partly a lot of this was because of Ben's foresight, but we've been investing in assets that have a long-term fixed rate debt in general, or some of them are actually cash only. So it's not probably going to affect us unless this hangs on for more than 5 years. But for folks out there in general, my multifamily mastermind yesterday, we spent an hour and a half a month. And we went through and talked about some of the syndicators losing their deals or about to lose their deals back to banks or lenders. It could get ugly. Here's the thing, though. Unlike 2008, when you could buy those assets for less than half price sometimes, I don't see it this time. Tejas, I think that what's going to happen this time is there are these huge, huge groups like Oak Tree, Howard Marks, and others who have billions or maybe hundreds of billions of dollars combined to go in and buy these assets up. I don't think most of us are going to see the great deals. What do you think?
I'm afraid of that, and a part of my world is staying in one geographic area. So I just practice in a 2.5 hour radius, and I'm very microeconomics. Yeah, the whole blood on the streets thing. That's what everyone's waiting for. I agree. I don't think it can happen with us not being at 2% and the Fed's trying to get there. There's got to be a lot of pain and like discomfort to change things. But the economy is too healthy and everyone still
Right.
wants to buy everything. It's kind of terrible.
Yeah, it's really crazy. The supply and demand inequity, or the out of balance supply and demand is enormous in housing,
Mhm.
especially in multifamily. It's going to get worse if a lot of these projects grind to a halt here, and they are.
Yeah, we're watching it happen. You mentioned something, and I hate it that we already got to start concluding things, but you mentioned something interesting. 5-year fixed. But before that, you mentioned funds that are taking variable rates and some issues. Can you tell me how you've seen some other funds? You don't have to mention anything, but like them not do as well as you are because you're being really risk averse.
When I was back there screaming about multifamily not being the perfect investment for those years, we were talking about overpaying, over assuming, that rents in Tucson are going to continue going up 18% a year. Well, that's just not probably going to happen. Let's not assume that. And we were concerned about over leveraging and the floating rate debt. But what I didn't realize was the power, or the horrible negative power, I should say, of floating rate caps. And these borrowers, I've got two friends. One of them said his rate cap guarantee that he bought, which is basically a temporary guarantee that your interest rate won't go above a certain level. It was called his reserves for it. That's what I was trying to say. His reserves for the future rate cap replacement were running $1,000 a month, and they went up from 1,000 a month by the lender. The lender mandated that they crank it up to 89,000 a month. And
That's
somebody
insane.
else was paying 2,000 a month, and they got cranked up to 70,000 a month.
Are you
Can you
saying are you
imagine how that impacts a deal?
are you saying 70 times more?
Yeah, I'm saying that, yeah, one guy went up 89x and another went up 35x. How are those guys gonna sustain their distributions to investors, but how are they even gonna survive?
Honestly, when I hear stuff like that as a fund manager and a fiduciary, I'm like, how do you sleep? Where, like, how do you talk to your investors that you've been, communicating with? But yeah, this is why I love talking to folks like you. And I really rely and have a lot of respect for my elders who are willing to share information. But you've been awesome. I could probably talk to you for the next couple hours. How does somebody invest with you or get a hold of you or be a part of the Wellings
Yeah.
Capital world?
They can follow me on Twitter at Paul Moore Invest, or they can get free special reports on RV park investing, self storage, mobile homes, and a lot more by going to Wellings Capital. That's WELLINGS, wellingscapital.com/resources.
Thank you for that. And everything for the listeners is in the show notes, and we will have your website link. But I got to always give my stamp of approval. Paul, you're amazing. Full endorsement to invest in you and a fund that is this risk averse. So I love your style, and I can't wait to have you back in the future.
Oh, thank you. I'd love to come back. Thanks so much.
For sure. It's Real Estate Investor MBA. I'm Tejas Gosai. This is Paul Moore. Thank you for your time. Cheers.